This is FRM Part 2, Book 5, Risk Management and Investment Management, and the chapter on Portfolio Performance Evaluation. This chapter was taken right out of a textbook called Investments, written by Bodie, Kane, and Marcus. I've actually used this textbook in my graduate investments class, and this is purely an investments chapter, and you'll see that as we go through the learning objectives. We'll start with some simple measures of return. We'll move on to some risk-adjusted performance measures, some of which we have spoken about before, some are going to be new. We'll talk about statistical significance as it relates to things like style analysis and maybe changes in portfolio risk, and in particular, market timing ability. And then we'll have a couple of slides, at the end of the slide deck on something that's really cool, known as performance attribution analysis. Let's start with a measure of time-weighted returns. This was developed years and years ago so that mutual fund managers had a way of evaluating their performance over time. And of course, it extended to investors and the use by investors so that we could evaluate the performance on a relative basis between and among fund managers. It's a relatively simple process. Look at the steps down there at the bottom of the page. We'll create new subperiods. We'll calculate holding period returns for each of those subperiods. And at the risk of offending you, let me just remind you about a holding period return. This is the super simplest of all calculations. If we have an asset that we bought at 100 and then it's currently valued at 110, holding period return, of course, is 10%. You take the 110 minus the 100 divided by the original 100. That gets you that 10%. And then in the final step, we have to remind ourselves of time value of money compounding principles. And so we're going to have to subtract 1 from that result after we multiply those compounded returns. Let me show you how easy this example is. Let's suppose that we're an investor. We buy one share of stock today at $50. It's worth $55 at the end of the first year, and we buy another share at the end of that first year. And at the end of year 2, the price has risen to $65. So do you see that timeline? We go from 50 to 55, then all the way up to 65. And then during that time period, just to make life interesting, let's suppose that there's an interim cash flow of a dividend paid at the end of year 1, at the end of year 2. So let's go ahead and look at essentially a table, which is a timeline. So what happens in year 2? We're out $50 to purchase that first share, right? At the end of year 1, we're out $55 to purchase the second year. But at the end of the first year, we get the dividend on that first share of stock. At the end of the second year, we get a dividend on both shares of stock. So there's the $2. And then the total value of our 2-share portfolio, right? 65 times 2 is 130. So there's a good example of separating these into their sub-time periods. Now we'll compute the holding period return for each of those periods. So the holding period return for year 1, there's the 12%, right? From 50 up to 56. We have to add the 1 of the dividend payment. And then the holding period return for year 2, we've got the 55 times 2. So that's the 110 all the way up to 130 plus the $2 dividend. So we have 12% in year 1 and 20% in year 2. And you know, what you're tempted to do is say, okay, 12 in year 1, 20 in year 2, add those, you get 32, divide by 2, and you get 16%. And that, of course, will give you some general sense of the performance of this share of stock over 2 years, but it's not precise. And as good financial risk managers, of course, we have to be precise. So let's go ahead and compute the geometric mean. So let's add 1 to each holding period return in its decimal form, of course. So you have 1.12, multiply that by 1.20, and then, boy, once again, I tell my students this all the time, you're tempted to divide by 2, but that ignores the compounding effects of time value of money, so you raise it to the 1 over the number of time periods. So you could do this for 100 time periods, and you'd have to raise it to 1 over 100. I call this decompounding. I'm not sure that's a word, but I'm sure that you can figure out what I mean by it. So we raise it to the 1/2, and then we subtract 1 because we're multiplying 1 times 1, so you got to get rid of that. So there's 15.93% time-weighted return for this fund manager. And of course, the important thing to do, I'm sorry, this is for a share of stock, but if this were for a mutual fund, then the important thing would be to compare this time-weighted return across multiple fund managers. Now, the dollar-weighted return, of course, is dependent on cash inflows and cash outflows. So for me as an investor in a mutual fund, what I can do is I can throw money at the fund manager every day, right? I could send $1,000 today and $1,000 tomorrow and $10,000 the next day. And then I'm going to receive my distributions based on the number of shares on that distribution date. And so the dollar-weighted return reflects those discounted inflows and outflows. Of course, look at that second teardrop point, sensitive to the timing and amount of cash flows. Now, of course, this is not precisely reflected of the performance of the fund manager, because as an open-ended mutual fund, the fund manager accepts my contributions at any time, and I can say to him or her, send me this amount of money every single day. And so this is for an investor who's got lots of turnover, lots of inflows and outflows. This is probably not too reflective of the performance of the fund manager. So let's take a look at an example piggybacking on what we did before. So there's our $50, there's our $55, and there's selling of the 2 shares at $65, and there's the dividend. So compute the dollar-weighted rate of return. And there's the timeline that we put together similarly from before, but we're going to use our cash flow buttons. So I'm guessing that those of you who know something about financial calculators look at the equation there in the light gray box at the bottom. What we're really doing is solving for R. And by the way, this is the IRR button, the internal rate of return button on the calculator. And so essentially we're saying that, look, time period 0, we have 50. Then in time period 1, we have 56. And then in time period 2, we have 132. So if you do the math in there, you get a dollar-weighted return of about 17%, which, of course, is different than what we did back here, which was about 16%. That second learning objective is a great reminder. Boy, we've talked about Sharpe ratios in multiple previous recordings. So there's our great formula and equation for the Sharpe ratio: return on the portfolio minus the risk-free rate divided by the standard deviation. In this case, notice there are bars above the R's, so that's an average return and an average risk-free rate. And so what is this? Total risk, right? The excess return per unit of total risk, that's standard deviation in the denominator. Total risk includes systematic risk and non-systematic risk. I always called it unsystematic risk. I think other chapters we've called it idiosyncratic risk. Not very useful on a standalone basis. Of course, we need to compare Sharpe ratios between and among financial securities or fund managers. And what do we want? We want lots of numerator, right? We want lots of excess return, and we want a little bit of denominator. We want a little bit of risk. So, of course, higher Sharpe ratios are superior. The Jack-Treynor ratio, this is virtually identical. However, Treynor assumes that we're holding well-diversified portfolios, and as such, we have eliminated the unsystematic component, so all we're left with is systematic risk. And so notice that instead of, here, let me go back here real quick, instead of standard deviation in the denominator, we have beta of the portfolio in the denominator. Now remember that standard deviations in the Sharpe ratio, they can range from I guess zero. There probably won't be zero, right? Because this is a mutual fund, equity, maybe fixed income portfolio. So probably won't be zero, but it could be relatively low, all the way up to, I don't know, 40%, 50%, 80%. But here, beta is constricted because it is a standardized random variable, right? Beta equals covariance over variance. So there's that second teardrop point, narrower measure than Sharpe risk, right? Not very useful on standalone. So once again, we need to compare. And again, we want lots of numerator and a little bit of denominator. So the higher the Treynor ratio, the better the performance. Jensen's alpha goes back to the mid-1970s. This is defined as the average return on a portfolio over and above the return on the market portfolio as predicted by the capital asset pricing model. Actually, that return over the market risk premium. So there to the right above the light blue box, there's the formula. Embedded in that is the capital asset pricing model. And of course, the alpha, you just switch right and left-hand side of the equal sign to get the equation for alpha. So what are we saying about Jensen's alpha? If it's positive, then the portfolio has outperformed the market. We've talked about that multiple times. If it's negative, it has underperformed. And so remember that one discussion we had on scaling alphas, so you can rank them according to all different sorts of factors and different kinds of scales. And so look at the bottom circle point there. Alpha is representation of the maximum an investor should pay for the active management of a portfolio. In other words, if the manager has an alpha of 5% and the manager is charging 20% for expense ratios and costs and fees and all that kind of stuff, then you should probably shake your head and say, why am I paying 20%? Information ratio, boy, this should be right in your wheelhouse. There it is. Instead of subtracting a risk-free rate or using the capital asset pricing model, we're going to use some kind of a benchmark. Let me just remind you, right? We have that average return on the portfolio, and we're subtracting the average return on a benchmark. Lots of times you might just automatically think that this is the S&P 500 index, but you don't really have to use the S&P 500 index. In fact, ideally, if you have let's say a 50 stock portfolio, what you ought to do is find 50 other stocks out there that are super similar to your 50 stocks and use that as a benchmark. Of course, benchmark creation is not an easy thing. It's timely, it's consuming, it requires all sorts of resources. And so there are lots of shortcuts to determine that benchmark. Nevertheless, this information ratio depends on that benchmark selection. And so once again, what we're trying to do is look at the trade-off between the alpha and the diversifiable risk. And of course, we want lots of numerator and a little bit denominator. So the higher, the better is the performance measure. Now here's one that hasn't come across any of our chapters here. This M squared, noted for Franco Modigliani, who was a Nobel Prize winner, and his granddaughter, so M times M is M squared. And so look at the equation down there at the bottom. So M squared is equal to the Sharpe ratio multiplied by some kind of a standard deviation, and we're going to add that risk-free rate of interest because that's always the starting point, right? We would never invest in a fund manager if he or she was not going to at least outperform the risk-free security. And remember, there's a B subscript on that standard deviation, and that's the standard deviation of the benchmark. So we're going to take that Sharpe ratio, which is a measure of performance, and then we're going to weight it by some measure of risk, right? Standard deviation of the benchmark portfolio, and then we're going to add the risk-free rate of interest. So this is why this thing has become, relatively popular. Its base is in units of the percent return. So we can make a direct comparison against against 0, because it's a lot easier to interpret. So if m squared is greater than 0, the portfolio manager has a positive risk-adjusted return, and then if it's negative, etc., etc. Yeah, let's go ahead and scratch our head and say, boy, we have all of these researchers out there who are kind of duking it out, saying, okay, use mine, mine's best. Boy, so what do we say? Really, it depends on the construction of the actual portfolio. Sometimes Sharpe might be appropriate, sometimes Treynor might be appropriate. However, what lots and lots of researchers have decided is that if we have lots and lots of alternatives out there, let's go back to Jensen's alpha because it uses the capital asset pricing model, or the Treynor measure because it uses beta, which is our measure of systematic risk, assuming that we have diversified portfolios. Now, how about statistical significance of that alpha? So look at that first arrow point. Alpha plays a crucial role in determining portfolio performance. Of course, we've known this for many slide decks. Positive alpha indicates superior performance. Well, the question then becomes, if we have a positive alpha or if we have a negative alpha, can we say with confidence, hey, look, we know this manager has a 2% alpha. Let's go ahead and throw all our money at this particular manager. But it might be that 2% is not statistically different from 0. So look at the bottom circle point there. We have to conduct a test of the hypothesis. Is it skill? Is it luck? Or is it something else? Well, we need to go back to our undergraduate days. Remember your first stats class? I never had statistics in high school. So when I got to college and I had my first stats test, my first stats class, and the professor's throwing all this stuff at me, null hypothesis, alternative hypothesis, critical values, I remember sitting in class thinking that my head was going to explode. And it took me about 2 weeks to figure out that, hey, this stuff is not very difficult. All right, so there's our test statistic. What we're going to do is we're going to compute this test statistic around a hypothesis. So the null hypothesis is always that, not always, but in many cases, that something is 0, whatever that is. So here we're going to say that the true measure of performance is that this fund manager is no different than anybody else, right? The true alpha is 0. As opposed to the alternative hypothesis that it is not equal to 0. So this is a two-tailed test. There's the test statistic. We're going to take the alpha in the numerator minus the 0, right? That's part of the null hypothesis. I mean, you think about it. You could say null hypothesis, the true alpha is 20%. And, you're going to reject that all the time, right? So we'll just say numerator alpha minus 0. And then, of course, we have to standardize that in the denominator. And the way we do that is we take a measure of volatility. Of course, it's going to be standard deviation. And then we need to take the square root of n. Remember, that as a penalty. Square root of n is a penalty for using not the entire population, but just a sample. All right, let's go ahead and look at an example. Let's suppose we're doing 95% confidence level. All right, so here we go. Experienced manager performance over the last 340 months against a market index. This regression provides an excess return. Remember, that's the alpha of 0.28%, standard deviation of 2.5%. Here's the question. Is this manager showing superior skill set, superior ability at the 5% level of significance? All right, so we take 28 minus 0.28 minus the 0 divided by 2.5, square root of 340. That gives us 2.8. So the critical value at 5% is 1.96. So our test statistic falls outside of that range. So what we can do is reject that null hypothesis and say, yes, this manager, she has superior performance. Her alpha is statistically different from 0. I'm guessing that this is a review slide for those of you who just watched the hedge fund recording. So what do we get out of this chapter here? Investing in hedge funds helps investors complement their well-diversified portfolios. All right, and we talked about this. Let's put a bunch of our wealth in a passively managed fund. Maybe it's the S&P 500 index fund, and then let's allocate some funds so that we can go over here and do something else with it. And so that something else is, whatever the hedge fund manager wants. You guys remember the story I told you about Barbie dolls. But it could be gold mines, it could be commodity futures contracts, it could be an oil well, it could be almost anything out there, right? So the goal here then is to provide the investor with a positive alpha over that extra or that whatever that hedge fund manager is selecting. All right, so what are these difficulties? Here's the learning objective. We know this. Hedge funds assets are often illiquid. Think of my Barbie doll example. Hedge fund risk, there's no way that this is constant over time, because if I'm buying a bunch of Barbie dolls and then I'm selling a bunch of Barbie dolls as a hedge fund manager, and then I'm using those proceeds to buy some kind of, let's say, Hollywood memorabilia. Maybe I bought the Indiana Jones hat, and then later on I bought the Indiana Jones whip, and then I bought the hat that James Bond, that Sean Connery wore in the third movie. So I'm replacing Barbie dolls that has some risk with Indiana Jones collectibles, which has another level of risk. So of course that's not constant over time. Oh, we talked about this before. The sensitivity of hedge funds with traditional markets has been observed to decrease during turbulent times, only to increase when the market is strong and stable. So there's that convergence or divergence of hedge funds risk during periods of stress or periods of market euphoria. All right, moving on to the learning objective regarding changes in portfolio risk, right, using the Sharpe measure. All right, let's go ahead and think about it this way. When using performance measures, dynamic risk levels can lead to erroneous conclusions. Let's look at this example. Suppose the market index has a Sharpe of 0.32. So we've got a fund manager who is going to pursue a low-risk strategy during year one and beats the market during that first year, and then pursue a high-risk strategy during year two and beats the market. So let's go ahead and look at this summary table. So there's year one, and we have a low-risk strategy. There are the 4 quarterly returns in green. Mean return is 2. Standard deviation is 6, so Sharpe ratio 2/6 is 0.33, right? Superior performance, what was that benchmark? There's the Sharpe of the market index, 0.32. All right, so during the second period, we pursue high-risk strategies, and in orange, of course, those have much wider variability, so those reveal higher risk. So there's the return of 5, standard deviation of 15. So during that second year, 5 divided by 15 is 33. So that's superior performance. So think about what's happening here. Superior performance in year one, superior performance in year two. And so we automatically think, oh, superior performance over that 2-year window. But if you lump all those quarterly returns together, compute the mean and the standard deviation, notice the mean is exactly in between 2 and 5, right? But the standard deviation is not exactly in between because of the way you calculate standard deviation. Sharpe ratio is only 31, which indicates inferior performance. So going back to that first embedded circle point, so when using performance measures, dynamic risk levels can lead to erroneous conclusions, and that's what this table considers. So note what that last sentence reads. This shows that it is important to consider changes in portfolio composition when using performance measures such as the Sharpe ratio. Now, of course, if this manager had low risk performance low risk strategy in year 1 and low risk strategy in year 2, and those two low risk strategies resulted in identical standard deviations, then this wouldn't be a problem. The problem is switching Barbie dolls for Indiana Jones memorabilia. I'm just assuming that those two have different standard deviations. I guess you'd have to empirically test it. All right, how about market timing? This is a great slide because it says something like this. You know, if you could time the market, you really would be able to beat anybody else out there. And so this, of course, is true. So some of the summary descriptions inside of this chapter are here in these target points. Manager intent on using market timing strategy acts in one of two ways. Includes high beta stocks when they are bullish, low beta stocks when they are bearish. That's kind of an obvious notion. And so what will happen, the manager will beat the market as long as that macroeconomic estimate was accurate. Now, because of that, it makes perfect sense then that we can empirically test whether a manager has superior market timing skills based on bullish or bearish markets. Now, I'm guessing you would have anticipated that some researchers would have come up with a regression model to test this. And of course, here it is. Notice on the left-hand side of the equal sign, we've got the return of the portfolio. This is the excess return. So we're going to try to explain that by using these independent variables. There's the excess return on the market portfolio. There's the R sub EM. And then notice that there's a big old D somewhere over there. And by the way, this excess return is also net of the risk-free rate of interest. Notice there's a big D out there on the right in between those two plus signs. This is a dummy variable. And dummy variables are very useful when you don't have complete data or you have qualitative data, or it just kind of lends itself that we need to use some kind of a dummy. And a dummy variable, for those of you who don't know this, is exactly what its name suggests. It's dumb. It can only take on two values, a 0 or a 1. And let me just give you a quick example, going back to my sports analogies. You know, let's suppose you're trying to evaluate the performance of LeBron James in an NBA basketball game. And what you want to do is see if his foul shooting performance inside of a game explains his performance maybe after he shoots a foul shot. And so you think about this from a quantitative standpoint. If LeBron shoots two foul shots like they do in the NBA, you know, he can either make both or miss both or make one. So if you use the percentage, you know, it'd be 0% or 50% or 100%. And that really doesn't make a whole lot of sense, 0, 50, or 100, to explain whatever kind of performance measure that you're using for LeBron after he shoots some foul shots. So what we can do is we can say, hey, let's use a dummy. And let's say if LeBron makes the foul shot, that's a 0. If he misses a foul shot, that's a 1, or vice versa. It doesn't really matter which way you do the 0 or the 1, as long as you keep track of them. Now, some of the interesting interpretations of this regression equation: in a bull market, beta is equal to B plus C. In a bear market, beta is simply equal to B. So what we can do is we can evaluate the performance of a manager with a t-test surrounding C. All right, so notice, let's go back here. So B is the beta coefficient, right? Just like we've always had it. Alpha is a measure of alpha. In this case, it's going to be security selection. And then C is going to be the coefficient that is the difference between the up and down markets. So we're going to assign a value to the dummy of 0 for down markets and a value of 1 for up markets. And then that coefficient C is going to tell us whether or not LeBron is sensitive to whether or not he makes or misses a foul shot. Here, the performance, the excess return, right to the left-hand side of the equal sign, whether that excess return depends on whether LeBron makes or misses a foul shot. But we're not doing that. We're saying whether it's a bear market or a bull market. So what's going to happen here is that a positive coefficient C that is statistically significant will show evidence of market timing ability. Now look at the bottom point there. The existing body of empirical evidence gathered from mutual funds suggests that C is negative for most funds. Of course, we would think that market timing is difficult. And so here's a table that is taken from the Journal of Applied Business Research. And what this author did was, for the period of 93 through 97, evaluated 19 mutual fund managers that were operating in Athens, and did monthly returns over that 4-year time window. And the interesting part about this was that they used the Newey West method for correcting for heteroscedasticity. Remember our discussions on correlations and serial correlation and heteroscedasticity. So the point of that is that this is a pretty robust way to evaluate our equation that's in right at the top of that red table. All right, so there are the parameters, there are the coefficients down on the left-hand column, A, B, C. And let's skip to the middle one. Notice that the coefficient B is positive and statistically significant for all 19 mutual fund managers. Of course, we wouldn't be surprised at that. We'd be surprised if it were anything different, right? So let's go ahead and just quickly look at the alpha. So what are we saying there? 15 alphas were positive, 4 were negative. However, only 4 of these were statistically significant. The remainder were statistically insignificant. And so the alphas probably for these 19 managers on average is pretty close to 0. Now, what would be interesting, of course, this doesn't have anything to do with this chapter. What would be interesting is to find and track those 4 statistically significant fund managers and see how they do in subsequent time periods. But go ahead and look at the coefficient for C. All right, so 5 were positive, which indicates some ability to time the market. 14 were negative, but of course we need to attach statistical significance. Look, only one of the 19 showed the ability to statistically beat the market. 4 were negative, so that's probably just turnover or whatever that can be attributed to. But look, the majority of them were statistically insignificant. And so this is not too surprising because, you think about fund managers, not just in Athens, but all over the world. Fund managers, they have money thrown at them every day, and they have people saying, I want my distribution today. So there's money going in and out. And so their ability to time the market, kind of depends on those inflows and outflows. I mean, suppose that we collectively throw $1 million at a manager today, but collectively we ask for $2 million in distributions. And on that day, the manager has private information and superior information to time the market, but there's only $1 million coming in and $2 million going out. Well, the manager doesn't really have enough time to time the market, enough funds to time the market. So those distributions are spread out over time periods. So these results are not too surprising. And so when you read that it's difficult to time the market, well, you can cite this Journal of Applied Business Research article. Now, how about a different way to measure market timing with a call option? I'm always fascinated by the use of derivative securities to kind of forecast or show some kind of ability here. So let's look at that first embedded circle point. Here's a big assumption. Let's suppose that there exists a manager with perfect market forecasting ability, right? Think of somebody who's always right. Not one of your friends who thinks they're always right, but somebody who is always right. So let's narrow down our choices. We can either invest in treasuries or we can invest in the Dow Jones average, all right? If the manager forecasts the Dow will outperform treasuries, they'll invest 100% of the wealth in the Dow. But if the opposite holds true, 100% in treasury bills, all right? So look at that table there. Manager's foresight, return on the market exceeds the risk-free rate, we'll invest in the Dow, and we'll earn the market portfolio, right? Assuming the Dow is representative of the market. If the treasuries outperform market, we'll invest 100% in treasury bills, and then we'll earn the risk-free rate. Now, this doesn't sound like a very interesting kind of a scenario. However, I assure you that it is. So look at the purple box at the bottom. We're going to demonstrate that the returns to owning a call option plus treasury securities are identical to those 100% forecasted returns. All right, so this is what we're going to do. We're going to consider a manager who decides to invest in both assets. So they invest in the current value of the Dow, that's noted as S sub 0, and we're going to invest that in treasury bills. So whatever the current value of the Dow is. Now, of course, in 2020, late 2020, we hit 30,000. But let's forget about that big number here. So let's just suppose that SO, whatever that number is, we're going to invest in treasury bills. And we're also going to buy a call option on the Dow with an exercise price equal to the future value of those treasury securities. All right, two cases here. Let's suppose the Dow outperforms the treasury bills, right? Return on the market exceeds the return on the treasury. So what's going to happen is the treasury bills will provide the investor an amount equal to, notice I put in purple there, so S sub 0 times 1 plus R at the maturity date of the option. And in red, I just used some real simple math. Let's suppose that the Dow, forget about the 30,000, right? Let's suppose the Dow is trading at 100 right now. Multiply that by a 4% return. I made that number up as well. So you take the 100 times the 1.04. So if you invest that entirely in treasuries, you'll have 104 at the end of time period 1, right? That's your treasury investment. What's going to happen to the call? At the end of that time period, the call will be in the money. Is that right? Oh, so let's figure this out. So the value of the call option is going to be the Dow at expiration, right, S sub t minus the exercise price, which in this case is 104, right? Let me just go back and remind you, what are we doing? The exercise price equals the value of the Dow if the latter grows at the risk-free rate. So our exercise price is 104. And so in order to get the ending value of the call option, all we really need to do is take the future value of the market portfolio minus the future value of the treasury bill. And that's what I did there. So 100, there's our Dow, times the 110. Let's just suppose that the Dow increases by 10%. So 10% is greater than 4% minus that 100 times the 104. That gets us 6. So if we take the 104 in red and the 6 in red, we get 110. And we can do this here using the big equation. And I'm guessing some of you guys think algebraically. So when I put the purple and the black up there at the top, you automatically said to yourself, you know what, those purple things, they're going to cancel each other out somehow. I'm not that smart. I don't think algebraically like some of you, so I love to do some math, and so that's why I put that in there. But of course, you guys are right. So the 104 minus the 104, so you're left with 110. So look at the very bottom there. In the upmarket scenario, the call plus the bills portfolio will have matched the performance of the market, right? 100 times 110, 100 times 1.10 gets us 110. And you can replicate that 110 by buying treasury bills and by buying a call option. So this is cool. When I went back here and did that top part, you thought, well, this is not very exciting. But here, this is pretty cool. Now, the second case is way easier. Let's suppose that the Dow underperforms. And so notice I've got the call option has no value. So there's our 100 times 1.0. So let's suppose that the return on the market is 0%. So that gives us 100 in red. The option expires worthless, right? You have the right to buy at 104. Why would you buy at 104 when you can buy at 100? So you throw the option into the circular filing cabinet. The ending result of the treasury bills will be 104. So in a down market scenario, the call plus the bill will return the risk-free rate of interest, which was 4%. And this example is pretty true for lots and lots of examples in finance where you can use a derivative security to layer some kind of another investment and it replicates or mimics the performance of something else. I show my students this all the time in class. So what kind of concluding remarks can we make here? So returns earned on the two asset portfolio, right? The call plus the treasury securities. The returns earned on that two asset portfolio are identical to 100% perfect four-sided returns. All right, so now what can we say? The value and the fee attached to the ability to time the market should equal the price of the call option on that market index. Once again, derivative securities provide us with a great value added in our understanding of portfolio performance. Oh boy, it would be awesome. We could just say, hey, this was enough for us to learn today, but it even gets better. All right, so there's a learning objective on style analysis. So what does this mean? Deconstructing the returns of an investment in order to identify underlying strategies or exposure to try to make a determination whether this is luck, whether it's part of the strategy, and can this persist over time. All right, so style analysis, two things: asset allocation, these are style bets, and selecting individual securities, as well as market timings, and these are called selection bets. Bodie, Kane, and Marcus refer to a study on Fidelity, one of the Fidelity's fund. The study makes some conclusions. Managers should focus on style bets. Security selection returns are low, if not outright significant. So look there in the blue box, only 2% of the funds returned were explained by selection bets. And I've said this to you before. What matters most is asset selection. What matters most is asset allocation, not the individual security selection. So it doesn't really matter which securities that you buy, it's how you allocate them. And that piggybacks on what we had back here, right? What do you want to do? You want to allocate. If you have a down market, you want lots and lots of treasury bills. If you have an up market, you want lots and lots of Dow. That should make perfect sense. So we hit this final learning objective about performance attribution. This is called attribution analysis, and I take my students through this. This is really, really cool stuff here. What we want to do is decompose performance into its two components. And those components, in our example, will be twofold, but they can be broken down into many, many different types of components, like industry or sector choice, up and down markets like we just did, fixed income, money markets, or equity markets. So here's the procedure. Let's set up a benchmark or a bogey portfolio. The bogey portfolio is designed to measure the returns of an entirely passive strategy. We need a benchmark for each asset class. We need to select weights. We need to choose a portfolio security. Then we need to calculate the return on this bogey portfolio and then just subtract the two. We're going to explain the difference and then we're going to summarize the performance. So steps 1 through 8, they really don't offer too many practical applications here in terms of following the steps. So let's go ahead and work through an example. Let's start with benchmark return and the return on the managed portfolio. Notice that those two equations are identical with the exception of the subscripts. So over here on the left-hand side in red, we have the benchmark portfolio. And over here in purple, we have the managed portfolio, sub P, right? And so the weights on the benchmark are chosen based on market expectations. I mean, that makes sense. But what we're going to do then is we're going to compute the difference. And so notice what we have in that gray box at the bottom: return on the managed portfolio minus the return on the benchmark. You know, we can call that some kind of an excess return, but then we want to chop it into its basic parts. So notice all we're doing is we're bringing the subscripts all the way through So we're going to essentially, at the end, sum the difference between the portfolio weights and returns and the benchmark weights and returns. Now, to do that, let's go ahead and look at a precise example. All right, we're going to do this in twofold. So here's assets allocation in the middle column, security selection on the right-hand column. So here's our benchmark. There's our managed portfolio. So the benchmark consists of 60% equity, 30% bonds, and 10% cash. Our managed portfolio is going to deviate from that asset allocation by overweighting equity, right, 70% versus 60%, underweighting bonds, right, 30% versus 7%, and then overweighting cash. Over on the security selection, our benchmark includes the S&P 500 index for the equities, the Barclays index for fixed income, and then Treasury bill index for the cash. All right, so what we're going to do is we're going to deviate from that. We're going to put some stocks that are not inside of that S&P 500 index. We're going to invest in fixed income securities that are not part of that Barclays index. And then we're going to invest in different kinds of Treasury bills, right? Remember, there's millions and millions of Treasury bills out there. Maybe we can substitute, 13-week for 26-week. So notice what we're doing here. As an active manager, we are deviating from the benchmark in allocation and security selection. So the question then becomes, are we any good at it? Are we any good at allocating? Are we any good at selecting? All right, so here's part of this procedure. We need to break this down into its two components. Asset selection, which is going to be the excess weight in the asset class times the benchmark return. And the security selection is going to be the weight in each asset times the excess return. So look on the far right column. We have the two W's. We're subtracting the two W's. So the weights in the portfolio minus the weights in the benchmark. And then under security selection, we're subtracting the return on the portfolio minus the return on the benchmark. And we're weighting them by the opposite, either the returns or the weights. And so there's that in the bottom right-hand column. There's that equation that we had, part of that equation that we had earlier. So what we're trying to do here is we're just trying to take the difference. Didn't I say that a few moments ago? We're trying to see if we're any good, and we're just going to take the difference between, let me go back here, our asset selection and our security selection. So there's our weights and there's our returns. All right, so let's throw a bunch of numbers here in a table. You ready for this? So look at the teardrop point at the top. The portfolio return over the month was 5.55%. So what we need to do is we need to say something like, okay, was that any good? And the first step is to say, all right, what was the benchmark return? And that's what I do for you there in the middle. Notice what we have. The bogey portfolio, we have 60% times the 6% return, right? Plus 30% times 1.8, 10% times 0.5%. So that gives us 4.19%. So all this table does is say, all right, our portfolio return was 5.55. The return on our market portfolio or the bogey portfolio is 4.19%. So everybody can agree that this is outperformance. So notice by the equal sign there at the bottom of the table, excess return on this active or the managed portfolio, the 555 minus the 419, that gets us to 1.36%. So clearly we can all agree that we have outperformed this bogey or benchmark portfolio. But this performance attribution analysis is now going to go back here. Let me go back here. We're going to say, all right, where did that come from? Did it come from asset allocation or did it come from security selection? Which of those deviations can be assigned that outperformance, right? Were we really good at allocation? Were we really good at selection? Or maybe we were good at both. Or maybe we were super good at one and really bad at the other. That's what performance attribution analysis shows us. All right, so here's this big old table. And when I give a test to my students, I put this table right on the test with a bunch of blanks in there. All right, so what do we know? Down the left-hand column, so we have the equity, fixed income, and cash, right? So there is the weights on the benchmark, right? What was that? 6, 3, and 10. There's column 2. And then our weights were 70, 23, and 7, right? So column 3, that's the key column. The active weight or the excess weight, we're just going to take the difference between the two, right? The W, which is 0.7, minus W, which is 0.6. So that gets us 0.10. And we have a minus 2.3 and a 0.13. There's the return on the index, which, here, let me just remind you, that's given to us back in this table. And so do you see what we're doing? We're seeing how our weights, how our difference in weights affected the return on that index. So there, column 5, all we do is take 3 times 4 and we sum that. So contribution of asset allocation is 0.25. Let me go ahead and repeat that. Contribution of asset allocation is 0.25. So then, hopefully you guys know that my lectures are generally linear. So we probably have to have another table, right? So we had this table, asset allocation. We have to have another table to selection. So we're going to do the same thing. There's equity and fixed income at the bottom. So there's portfolio performance, 7.5 and 264. There's the index performance, 6 and 1.8. So there's the excess performance multiplied by that portfolio weight. So that gets us up to 111 in column 5. So what we can say is 1.11% of that excess return comes from security selection. So what we can say is that, you ready for this? Most of this comes from our security selection ability, 1.11. Only some of it, 0.25, comes from our ability to allocate those assets. And that takes us through this chapter. Once again, I would know that those last 2 tables, I love giving that question to my students, performance, attribution, procedures. And by the way, a lot of times on exams, what I do is I will make, all right, so this one here, so the excess return on the managed portfolio, I usually make that positive, right, 2 or 3%. And then what I do is I make up numbers so that one of them is really positive, like 5%, and the other one is negative, like a minus, let's say minus 2%. And so we can make really, really good concluding remarks saying that, boy, we're really good at this part and we really stink at this part. And then note that I'd know how to calculate time-weighted and dollar-weighted returns, but I'm guessing you guys probably know that from before. Risk-adjusted measures, you guys know that. So let's just add the m squared to it. And then make sure you're aware of statistical significance as we've gone through this.